guys, it's me, Tasha, CEO and Chief Coach at Start Young Financial. And today I want to talk to you guys about the difference between a passive and an active investment strategy. And I want to talk to you guys about this because as you build your own portfolios, you need to be aware about the differences between these two styles. So as you know, I started investing when I was 19, and one of the first decisions that I had to make was what investment strategy I wanted to use. Did I want to focus primarily on actively managed funds, or did I want to focus primarily on passively managed funds when I was first starting out? So that is where I want to start with you guys today. Now, before we get into a deep explanation on that, I want to make sure that you understand the difference between active and passive investing. And with that being said, if you haven't had a chance to do so, I highly recommend that you check out my free video course called Invest for Success in 60 Minutes or Less. It basically runs through all of the basics of investing in a super simple way from an educational standpoint. So if you haven't had a chance to watch that, go ahead and do so, and it might make this conversation make even more sense. But nevertheless, even if you haven't watched the video, I'm going to give you a quick explanation on the difference between active and passive investing. So an active investment strategy basically means that you are investing in a mutual fund that has a fund manager, and this fund manager is picking the stocks that he or she wants to go into this mutual fund. And obviously the fund manager is going to make an effort to pick stocks that they believe are going to outperform the market. However, we know that investing in the stock market is not an exact science, and that past performance does not predict future performance. So no one actually knows if they're picking the right stocks or not, but they're going to make their best guess and hope that their mutual fund beats the market. And a passively managed fund is completely different. They're referred to as ETFs or index funds, and basically they track an index. So instead of trying to pick specific stocks to put in the mutual fund, an index fund or an ETF basically tracks a specific index that is a specific segment of the market or the market overall. So for example, an index would be something like the S&P 500. That's just one example. So with that being said, that's the difference between a passive strategy and an active strategy. In an active strategy, a fund manager is actively trying to choose which stocks. In a passive strategy, we're just going to say, we're just going to take it all. And what that does is it gives you automatic exposure and diversification to the total market. So that's the difference. So now that you know the difference, you might be wondering, okay, what is the best strategy for me? History has shown that passive funds outperform active funds. Now let me be clear, there are certain circumstances in which active funds can outperform passive funds. However, you have to be really smart to know when we're in that type of environment, because the stock market changes all the time and you cannot predict the future. So that's why I'm a huge advocate for passive investing. I think it's awesome, but primarily I like it because of the expense ratio. So if you don't know any other technical financial term, today I want you to learn expense ratio. And an expense ratio is essentially how much this stock is going to cost you. So every single stock, mutual fund, ETF, index fund has an expense ratio. And when I am building out my portfolio, that is one of the main numbers that I want to look at. Because while I can never know how the stock market can perform, my expense ratio lets me know how much of my return I will actually be able to capture. So the higher the expense ratio, the more you're going to have to pay someone to manage that fund. The lower the expense ratio, the more money you get to keep in your pocket. And so that is the main differentiating factor for me. So I want to emphasize, don't get too caught up on the difference between passive and active investing strategies. What you should be even more concerned about is how much is this fund going to cost. Now, the reason that I normally favor passive strategies is because passively managed funds like ETFs and index funds, by and large, have lower expense ratios. However, I have found a lot of great high-performing mutual funds that also have fairly low expense ratios. And I'm also an advocate of diversification, so I think it's important for me personally to have at least a couple of actively managed funds in my portfolio to catch any upward any upward trends that I may be able to capture. You just never know. There is also a new strategy called smart beta, and I don't expect you to know what that means. You don't have to go look it up, but essentially smart beta is a strategy that tries to allow passive funds to mimic certain aspects of actively managed funds so that the passive funds can get the return of a fund that has a higher risk factor, but that passive fund isn't actually more risky. So I think that's really interesting about a lot of these hybrid models that are coming along, trying to figure out how can we take advantage of active models and still get low expenses. That's really what you want to look for as you're building out your portfolio. But right now, as a basic thing to think about, just look at the expense ratio and obviously the return. Keep in mind that I am not giving you investment advice. I want you to have exposure to what's going on in the industry, and I want you to increase your knowledge base. And that's what I'm here for. As you learn this stuff, you need to be able to make decisions on what's going to be the best action plan for you. So that's what I want for you, and I hope that you learned something. If you have any questions, as always, feel free to put them below, and I will be there to answer them. In the meantime, I want you to let us know, what do you think is one stock, mutual fund, ETF, or index fund that you think would be a good investment for you right now? That's how you get started. Put this stuff to use. All right, guys, as always, I'm your sister in finance, and I'll talk to you later. Bye.